Right now, today, there are 5 bills sitting in your mailbox or your bank account that you are legally permitted to stop paying, and the odds are strong that you are still paying every single one of them, not because you made an obvious mistake, not because you were careless, but because the people collecting that money have absolutely no incentive to tell you that you are allowed to stop. Here at Retire Alert, we have spent years helping retirees hold on to more of their own money. And we can tell you with complete confidence the system is not designed to remind you of what you are owed. That responsibility falls to you or to someone willing to show you the truth. Stay with us for the next 13 minutes because we are going to walk you through all 5 of these bills one by one, plus 3 bonus moves at the end that can be worth even more. And we are going to tell you exactly which ones apply to your situation. Whether you are living mostly on Social Security or you have a pension, savings, and a paid-off home. Here is the one thing you need to understand before we go any further, because it is the reason most people never fix this. Being legally exempt from a bill and actually not paying that bill are two completely different things. The law does not automatically refund you. Nobody mails you a check. You have to know the rule exists, and you have to claim it. That is the entire reason we are here. Bill 1. Federal income tax for millions of Americans who are 65 and older. The correct amount of federal income tax they owe going forward is far lower than what they are currently paying. And for a significant number of them, the correct number is zero. Zero. Yet they are still paying it or still having it withheld from their checks every single month, out of nothing more than habit and a quiet fear that something bad will happen if they stop. Here is what actually changed. There is a new law. You may have heard it referred to as the One Big Beautiful Bill. Buried inside it is a provision called the Senior Bonus Deduction. Starting with the 2025 tax year, the one you file in early 2026, every person who is 65 or older receives an additional deduction of up to $6,000. If you are married and both spouses are 65 or older, that figure doubles to $12,000. Here is what makes it genuinely powerful. That $6,000 stacks on top of everything you already receive. It sits on top of your regular standard deduction. It sits on top of the additional senior deduction. Bill 3. Property taxes. Here is why the next one makes people genuinely frustrated when they finally find out. Property taxes are the bill where there is the most confusion and the most unnecessary overpaying across every income level. The reason is that seniors at both ends of the income spectrum have been told they do not qualify, when very often they absolutely do. Here is how it actually works. There are 3 distinct types of senior property tax relief, and between them, they cover almost everyone. The first type is income-based, often called a circuit breaker, and it is aimed specifically at lower and fixed income seniors. If your income is modest, this can reduce your property tax dramatically. In some counties, a low-income senior can have a large portion of their home's assessed value exempted or the tax deferred entirely until the home is sold. The second type is a flat senior exemption that removes a set amount of value from your taxable assessment regardless of income. This one reaches into the middle class. The third type is the one that comfortable retirees almost always assume they are too well off to qualify for. And this is exactly where real money gets left on the table. It is an age-based freeze. No income test, no means test. You qualify because of your age, period. In Texas, once you turn 65, your school district property taxes are frozen at the level you paid the year you reached that birthday. Your home can double in value, your frozen tax does not move, and there is no income limit on that freeze whatsoever. Texas is far from the only state with a program like this. Look at how those 3 programs together serve both groups. The lower income senior gets the income-based relief that can eliminate most of the bill. The comfortable senior, who assumed they were excluded, still qualifies for the age-based freeze, saving hundreds of dollars every single year for the rest of their time in that home. Here is the catch that costs everyone regardless of income. None of these programs are automatic. Your county does not look up your birthday, see that you turned 65, and apply the discount. You have to apply. And nearly every one of these programs has a hard annual deadline, often early in the calendar year. Miss it, and you pay the full bill that year and wait 12 months to try again. One phone call addresses this. Contact your county assessor or search your county name plus the words senior exemption and property tax freeze and ask 2 questions. What relief do you have for homeowners over 65, and which programs are age-based with no income limit? That one call has been worth hundreds to thousands of dollars per year at every income level. That is bill number 3. Bill 4, Medicare, overpayments. Bill number 4 is actually hiding 2 separate overpayments inside it, and one of them is specifically for the retiree who has built a solid income. Medicare is where 2 completely separate overpayments exist side by side, and most people are not aware of either of them. The first overpayment affects everyone, and it is straightforward. Medicare. Part A, the portion that covers hospital stays, is supposed to cost you 0 in monthly premiums if you or your spouse worked and paid into the system for at least 10 years, which equals 40 quarters. The vast majority of Americans have done exactly that. Yet some people are paying a Part A premium they never needed to because of confusion around a work record, a spouse's Bill 5, paid tax preparation. Every year, millions of seniors walk into a storefront tax office or a well-known chain and pay somewhere between $200 and $500 to have a fairly straightforward retirement tax return prepared. A significant number of those people legally qualify to have that exact same return completed for free by professionals that the Internal Revenue Service itself has trained and certified. There is a program built specifically for seniors called TCE, Tax Counseling for the Elderly. It is an IRS program for people 60 and older, and it specializes in exactly the questions retirees face: pensions, Social Security income, and retirement account withdrawals. The largest provider of TCE services is AARP TaxAid, which operates thousands of sites across the country. You do not have to be an AARP member to use it. The program focuses on older adults of modest to moderate means. And that phrase matters because it does not mean only the lowest incomes. It covers the broad middle as well. Beyond that, the federal government now offers its own free online filing options for retirees who are comfortable doing it themselves. There is a real distinction worth acknowledging. If your situation is genuinely complex, a business sale, rental properties, a complicated estate, then yes, pay a qualified professional. It is worth every dollar and the right move. But if your return involves a couple of Social Security checks, a pension, and a few investment statements, the law has already created a free and fully qualified option for you. Your age makes you eligible regardless of whether you are managing a fixed income or sitting comfortably. Using the free option is not a sign of financial struggle. It is a smart financial decision. That is Bill number 5, and it is one of the easiest to act on before this tax season ends. 3. Bonus moves. We promised you 3 bonus moves, and here is who they are specifically for. The 5 bills we just covered reach across every income level. These last 3 are specifically for the retiree who has accumulated assets, a home that has appreciated, an investment account, a healthy IRA. If that is not your current situation, everything you need is already in the first 5. But if you have built something, these 3 moves can be worth more than everything else combined. Bonus. Move 1. The home sale. Exclusion here is the fear that keeps people frozen in place. You purchased your home decades ago for $80,000. Today, it is worth $400,000, and you are concerned that if you sell it to downsize or move closer to family, the government is going to tax that enormous gain. So you stay in a house that is too large and too expensive to maintain, afraid of a tax bill that in most cases does not exist. There is a provision called the home sale exclusion. If you have lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain if you are single, and up to $500,000 of gain if you are married filing jointly. Gain meaning what you sold it for, minus what you originally paid, minus the improvements you made over the years. A couple who bought at $80,000 and sold at $400,000 likely has a gain of around $300,000 after improvements. As a married couple, they can exclude $500,000. Their federal tax on that sale is zero. They were staying in the wrong house for the wrong reasons, afraid of a tax that was never going to affect them. Bonus Move 2. The 0% capital gains bracket. If you have money sitting in a regular brokerage account, stocks or funds that have increased in value, there is a bracket in the federal tax code that most people outside of financial planning have never heard of. The 0% long-term capital gains rate. When your taxable income is low enough, the federal tax on your long-term investment gains is not 15%, not 20%. It is zero. For 2025, a married couple can have taxable income up to roughly $96,700 and still pay nothing on long-term gains. For a single filer, that threshold is around $48,000. And that is taxable income, meaning after your deductions have been applied. So a couple bringing in well over $100,000 total can still fall into the 0% zone after the standard deduction and the senior bonus deduction, and sell appreciated investments without paying a single dollar of federal tax on the gain. The years immediately after retirement, before large required withdrawals begin, are often your lowest income years. That is the window. A well-informed retiree harvests gains during those years deliberately, completely tax-free, instead of allowing everything to accumulate and be taxed at a higher rate later. Bonus Move 3. The qualified charitable distribution. This final move is for anyone who is 70 and a half or older, contributes to charity in any amount, and has money in a traditional IRA. It is called a qualified charitable distribution, or QCD. Once you reach age 70 and a half, you can have money sent directly from your IRA to a qualifying charity, up to $18,000 per year. That money is completely excluded from your taxable income. It never registers as income in the first place, which is even more powerful than a deduction, because it lowers the income number that everything else is calculated from. Your Social Security taxation, your Medicare surcharge, all of it. And once you reach the age when you are required to take required minimum distributions from your IRA, a qualified charitable distribution counts toward that requirement. So instead of being required to withdraw money, pay tax on it, and then donate what remains, you send it directly from the IRA to your chosen organization, satisfy your required withdrawal, and pay zero tax on any of it. If you contribute to any cause at all and you have an IRA, this is one of the most powerful tools available to you right now. Let us leave you with the one idea that connects everything we covered today. In every single case, the senior bonus deduction, the Social Security tax rules, the property tax freeze, the Medicare appeal form, the free tax preparation, the home sale exclusion, the 0% gains bracket, the qualified charitable distribution, the law already says you qualify. It already says you are exempt or you are entitled. But not one of them is automatic. The government does not refund you for a rule you did not claim. No one mails you a check for a deduction you forgot to take. The system is constructed so the money stays exactly where it is, unless you stand up and claim what is legally yours. Being legally exempt is worth nothing until you act on it. Before you go, do one thing. Send this video to one person over 65 in your life. A parent, a sibling, a neighbor, a friend. It does not matter whether they are getting by on a single Social Security check or sitting on a paid-off home and a solid financial foundation. The odds are very good that they are paying at least one of these bills right now for absolutely no reason. One share from you could be worth more to them than any gift you will ever give. See you in the next one.